Get rich with CNBC TV 18. Financial partner Axis Direct.
Hello and welcome to this edition of Get Rich with CNBC TV 18. Our financial partner is Axis Direct, and a very good morning to all the viewers that have joined in online. We have our experts with us. I'm Nigel D'Souza, and with me is Reema Tendulkar. Hi, Reema.
Hi, Nigel. Well, the title says it all. Get rich. Who doesn't want to get rich? Even the ones who are richer just want to get richer.
Sure.
And who doesn't want that extra income coming in from the equity markets? And our first speaker is a market veteran. He's got 25 years of experience in the capital markets. He's a gold medalist chartered accountant, a merit ranking cost accountant. He's a pro, not just in equities, not just in fixed income, in gold and real estate as well. Please put your hands together for Nilesh Shah, the MD of Kotak Mahindra AMC.
So the topic of my presentation is how to be rich, which all of us want to be. There is one simple way to become rich. That's get a magic wand like Harry Potter that will fulfill all your desire. But as we know, Harry Potter exists only in book, not in real life. As kid, we were told there was a Santa Claus. When we grew up, we realized there is no Santa Claus. So get out of this mentality that there's some magic which will come and help you. Do you want to make up as much money as this guy? Of course, yes. No Gujubai ever says no to money. There are two ways to make as much money as Bill Gates. One is Plan A, other is Plan B. Plan A is very simple. You have to set up a company like Microsoft, which is today trading at $500 billion valuation, and you have to own certain percentage of that. You will become as rich as Bill Gates. That's the easier part that you and I can do. The tough one is Plan B, which all of us have failed to do. That was by Indian IT companies, Infosys, Wipro, HCL Tech. All Microsoft over the last many years have delivered about 10% US dollar return. If you had bought HCL Tech for 10 years, it would have delivered you double the return of Microsoft. That would have made you more richer than Bill Gates. So this is Plan B. If you can buy IT companies of India and hold on to it, you'll probably make more money than Bill Gates. This is the second richest person in the world. Do you want to make as much money as him? Of course, yes, why not? Unfortunately for Warren Buffett, there is only Plan A. That is to invest into Indian equity mutual funds. This is one particular fund of ours, which since 1998, when it was launched, has outperformed Warren Buffett by 7.5 times in US dollar return. And our fund has outperformed Warren Buffett by 7.5 times in last 18 years. In fact, this is something which I discovered day before yesterday. Our gilt fund has also outperformed Warren Buffett for last 18 years. So Indian fixed income funds are doing better than the second richest person's equity share in American market in US dollar terms. So forget equity. If you had owned just fixed income, you would have still done better than Warren Buffett. But unfortunately, when we look at our investor profile, they all come in for 6 months, 12 months, 18 months, and then they disappear. So this is the limitation. Everyone knows that Deepak Bhaini company, HDFC, is great company. Anyone who believes it's not a good company, unlikely. Over last 25 years, it has gone up, down, up, down, up, down, up, down. And on an average, the difference between high and low is roughly 46%. So effectively, if you are a smart trader, you would have bought HDFC at a lower level, sold at a higher level, and made 46% return compounded per annum for last 25 years. HDFC over last 25 years has delivered almost 80,000% return, and that's 31% per annum compounded. 66% of what you could have made by trading, but there are many uneducated, illiterate, semi-educated people who just holding on to shares have generated this return, but not even one smart guy who keeps and tells Deepak bhai ke tamara share ma trading karne maja aavi. So trading versus investment, my feeling is that for an ordinary person, if you are disciplined, if you are professional, it's a different ball game. But for an average individual, trading is injurious for your financial health. Now, many of us will have Maruti car and all of us aspire to have Mercedes car. So the way to buy Mercedes car is to buy Maruti shares 6 years ago at the same price at which you would have bought a Swift car. In roughly 6 years, Maruti is up 6 times. So you would have moved from Maruti Swift to Mercedes by buying Maruti shares. In 14 years, iShares has delivered as much return from the cost of owning a Fatfati that today you could have a Rolls Royce at your home. Long-term investment, that's the way to make money. And fortunately for you, next 10 years could be as rewarding as last 25 years. Regular investment, asset allocation. Don't put all eggs in one basket. Try to diversify across debt, equity, commodity, currency. I'm sure you'll become rich. Thank you.
Get rich with CNBC TV 18. Financial partner Axis Direct.
All right then, so we heard about the fundamentals of the market and how exactly you pick stocks, etc. But next up, we're going to have, we talk about charts, how does it look, head and shoulders, etc. Let me introduce Mr. Mitesh Thakkar. He's our technical analyst at CNBC TV 18. He loves playing table tennis as well, and he's a good friend of mine as well. Over to you.
How do price of listed stocks and indices react to identifiable price levels? All right. So you watch CNBC. You keep hearing us talking about supports and resistances. So when we talk about price points, we're generally talking about supports and resistances. See, theoretically, there's demand at every level, right? At every price, somebody is buying, somebody is selling. But when we talk about these price levels, we are more worried about identifying where there is concentration of demand or where there is concentration of supply. Having said this knowledge, and while this knowledge in itself is imperfect, all right, because support levels can be broken, supply levels can be broken. So therefore, this is an expected level, but having this knowledge can drastically improve your trading performance. So I have a very simple chart of IndusInd Bank over here. If you see this chart over here, in this period, which is basically starting from somewhere August to about November 2016, the price of stock on 7 different occasions traded above the levels of 1235 but failed to close above that. Now if I am just observing this and not applying any big technical tools, indicators, formulas, mathematical, etc., etc., what I understand from this chart is that there is some kind of supply zone around the levels of 1235. Somebody is selling. Now I don't know whether Nilesh Bhai is selling, I don't know whether XYZ is selling, but to me it is a very clear knowledge that this is an important level to watch out for. Having identified this, what can I do? If I am a trader, these kind of, identifying of these kind of levels help me with many important trading decisions. It will allow me to identify the level where I want to buy or take a long position, right? So you would want to theoretically buy near support levels and try to sell near supply levels. Is that right? You would also want to place your stop losses in that mathematical order. You would want to hold a position with a stop loss below support zones and keep a short position with a stop loss above your support zones. They also work as your profit booking target. So if you have bought near support level, you would want to try and sell where there is more concentration of supply, right? And most importantly, when these levels are violated, you will typically see that there has been a change in the demand supply equation. So when this thing happened, if you go back to the chart of IndusInd Bank over here, this is the day when the results were announced. And what I saw on the day of results was that, again, after having a 7 or 8% rally, the stock price failed to close about 1235, right? So I said, if somebody is holding it out, book it now. The next time to buy the stock is when you have seen the level, when you've seen the supply at level of 1235 being exhausted, which means that the buying force has become stronger and therefore is now willing to push the price above these levels of 1235. That happened after about 10 days. So about 10 days, the price was around levels of 1235, 1210, 1235, 1210. And I'm sure most of you could remember it because it was only about 4 weeks back. And then we saw that finally there was this crossover when the price started to move, trade, and then close about 12.35. So I had this knowledge of a price point. Now, how does it help me? If I was holding the stock, I could book my profit at 12.35. Maybe this crossover would not have happened, and I would have got an exit near the top, right? Once the crossover happens, I am now blessed with a new dose of knowledge. I now know that possibly that the force of buying is stronger, and therefore it is likely to push prices higher. So I again take a long position with an appropriate stop loss, possibly a 1% below 12.35, and then look for the supply, the demand to carry prices on the higher side. Is that fine? Perfect. So this is what we do. This is one way of, drastically improving your trading performance. Just by observations, or if many of you have broking accounts, I'm sure that most of the brokers these days, and Axis Direct would also possibly be doing it, they do supply you with some kind of charting or a technical analysis software. So by not putting in complicated tools or indicators, just by observing price levels, I think trading can be improved drastically. Thank you so much.
Get rich with CNBC TV 18. Financial partner Axis Direct.
Let's move on and get in our next speaker. We are now joined by Arun Thakral. He's no less a market expert. He's got more than 20 years of experience in the capital markets. He's currently the MD and CEO of Axis Securities. A big round of applause.
What I am going to talk about, let us clean ourselves, let us clean our mind so that we can make more money in stock markets. So now what I will do, I will take help of yoga. You will say yoga means yoga asana, so I will say yoga philosophy. I am a yoga practitioner. I had lot of interest in yoga philosophy. So let us use the principles of yoga to become rich. So there is one shloka of Patanjali which says avidya, asmita, raga, dvesha, abhinivesh, panch klesha. So these are the 5 kleshas. This is the clutter which you have to remove from your mind. This is the cleansing of yourself. So let us look at avidya. What is avidya? That means lack of knowledge. If you have no knowledge, how are you going to make money in stock market? Behind every stock there is a company. You should know the company. You should know the management. Within management, what you have to check, you should see whether they are having the kind of integrity, whether they have got energy, whether they are intelligent. So when you buy a fridge, what you do? You go to 2-3 different shops. You decide what kind of fridge you are going to buy, what is the capacity, single door, double door. But when you buy a stock, whether you do that kind of a research, so get some knowledge. So avidya is lack of knowledge as well as wrong knowledge. Don't get into the penny stock. Don't get into the over leveraged company. And investment in knowledge pays the best interest. And knowledge is power. That is what you should remember. So this is the first rule if you have to become rich. The second is asmita, which is ego. All of us, primarily in a bull market, we go over the top. We start believing that, yes, we know. We get into a false sense of superiority complex. We think we will all buy tech stocks once it doubles. And then at the end of the day, we lose. So be aware of your ego all the time. That is why they say knowledge of your ego is knowledge. And ego of your knowledge is ego. Try to understand that. Third is raga. That is attachment. Now attachment can be with an asset class. You may continue to love your FDs. You may continue to love your gold jewelry. You may continue to love your real estate. Because you are familiar with those asset classes. You have not seen the power of equity. And even if you are in equity, you love a particular stock. The stock fundamental has gone wrong. You have seen that stock coming down. So I have seen a person who was the chairman of a company. He was keeping a physical certificate. He has not dematted because his name was there. He has so much attachment with that piece of paper. So I think we should get over this attachment, because root of all the suffering is attachment. I think in stock market it pays up. The next is dvesha, which is opposite of attachment. This is you start hating stock market because you lost money in 92, you lost money in 2001, you lost money in 2008, you were buying all bad stock. Now you hate stock market. You think it's a gambling den. You do mental accounting. You think that if the money has come from stock market, even if it has gone, then it is okay. But your hard-earned money should not go into the losses. So I think you should come out of this dvesha. You should look at the market. You should see what kind of return equity has given over a period of time. So minimize this kleshas also. And finally, abhinivesh. That is loss. That is fear of loss. If 100 becomes 90, you start crying. But 100 becomes 110, you said, okay, chalta hai. But I think equity is a risky asset class. It will never give you a linear return. Sometime you will win, sometime you will lose. If you are winning more than losing, you will make money over a period of time. And fear you should use to your benefit. If you could have done that, then you would have bought on the Brexit day, then you would have bought on surgical strike day, then you would have bought on a Donald Trump day. Every year, year after year, you will get at least 3-4 opportunities in a year when there will be fear. So you conquer fear. They say, na, dar ke aage jeet hai. I think you should remember that. So if I am allowed to say, I think I follow these 5 principles and I talk about this principle. You can also please note down, I am not going to give you any stock recommendation, sector recommendation, but I think this 5 will help you in your lifetime to become rich. And economy is getting cleansed. You should also clean yourself and you will become rich. Thank you.
We're now going to start the most fun part of our session. That's the question and answer. I'm sure you have a lot of questions lined up after listening to all these presentations. So I request all our experts to join me on the stage.
All right, let's have our first query. I think Sir's quite eager, so Sir, you could go first query.
Yes, I wanted to ask one question to Nilesh Bhai about the industry bank. What's his other view on it?
Sir, I think last we had was targets around 1350, which the stock has done. I've not worked out the levels right now, but I think the last swing low, which if the chart you could possibly put in, I think as long as that is not being broken, see it's come out of the 1235 zone, which it was not able to clear last time. So I think this rally should continue for quite some time to come by. My sense is that I think it's 1290 or 1295, I don't remember the exact level, but keep a stop below that. As long as that is not being broken, the trend is on the upside, and as long as trend is on the upside, you will see stock keep making higher highs.
What's the broader range you are looking for?
Sir, I will not work with these kind of targets because long back I've stopped working with targets because typically my targets have no value. The trend has value. As long as the direction is on the upside, I would continue to hold. I can give you a target of 1450, 1425, whatever, but in all honesty, I think that has got no value. What is important is that as long as 1290 is not being broken now, the trend remains on the upside, and therefore it can go to 1400, 1500, and if you've done some good deeds and God is kind on you, 1600.
All right, that's about banking stocks. We have another query from Sir. Yes, sir.
My name is Ashit Kothi. Nilesh Bhai, this question, after demonetization, the third quarter results started coming out. Tier 1 companies, possibly lackluster on an average results. Tier 2 or maybe Tier 3 companies, suddenly we see surge in profits, be it dairy companies or poultry companies. You fail to understand how can there be a substantial jump in consumption or the profitability of a milk or a chicken. I mean, say, where exactly? Do we trust these results of these companies, or do we look at that category A companies where the results have been on okay?
So even category A companies, so far 37 companies of Nifty has delivered result. And if you take combined results, the profit growth is about 7%. But if you remove Bharti, ICICI and Axis, the combined profit growth is 17%. 17% year-on-year growth is not bad. It can easily justify 17 times forward earning. So yes, small and mid-cap companies have delivered good result. The large-cap companies compared to small and mid-caps have delivered slightly lower result. But 17% earnings growth for large-cap companies is still very positive. The second thing, all these results now are coming on an accounting practices and policies which is reasonably good. So I will take it at face value. Anyway, those companies whose numbers I don't believe, I don't consider in my universe. So they are clearly out. In my universe, most of the companies today are presenting numbers which are reasonably reliable. 2% here, there will always happen, but more or less they are all reliable numbers.
I have a small question for Arun sir. So what suggestions or what guidelines would you like to give to me, to a boy who has never started his career in the stock market? And I would like to be in the stock market.
What's your age?
21.
At this age, if you have decided to invest, I think obviously you have to get into the equity market, because as I explained in my presentation also, you are the best position. Maybe 10 years ago I could have given you this advice with a pinch of salt, because then the macros were against us. Now everything is falling in place. The kind of atmosphere we have in the country, even the outside factor like crude oil price, like the fiscal deficit. So we are going in the right direction. So you have to take part in equity. You have to do some kind of asset allocation. But asset allocation may be a major part of your income should go into equity. Whether you invest directly in the stock, then either you study, as I told you, get some knowledge, understand it, or go to an advisor. You can come to Access Direct, or you can go to any mutual fund, or maybe on an Access Direct platform you can invest in any mutual fund. But you cannot ignore equity and do some kind of asset allocation.
All right then, so those are all the queries that we did get in. I think let's put our hands together for all our three panelists. Remember, CNBC TV18, our team is very, very dedicated to you all. All the experts, we're up there, we're trying to solve all your queries, putting in a dedicated effort from our end and an honest effort as well. But till next time, thank you so much for joining in. Thank you so much for all your queries and your participation. On that note, we'll wind up Get Rich with CNBC TV18 today. Thank you so much.
Get Rich with CNBC TV18. Financial partner, Access Direct.